Okay, the Unum Group was created, not itself, but the kind of predecessor of this company was established in 1848. So it's more than 150 years ago. Okay, quite a long time ago, 170 years ago, right? 72 years ago. And it became public in 1985. Before that, it had a lot of acquisitions of smaller companies and were growing and expanding by buying other companies. Interesting fact when I was reading about this company that they bought accident insurance and like damage insurance and disability insurance in 1940. So it means that just when the Second World War started, and I thought, oh my goodness, it's probably the worst time to buy insurance company where you pay for damages and disability, because like it's 5 years war after that. But still, the company survived and still here. It means that they know how to run their business in this particular case. Now, for expansion part, because majority of their business was in United States, but in 1990 they expanded in United Kingdom through acquisition of National Employers Life Assurance Holding. And now they have a quite huge, it was one of the biggest insurance companies in United Kingdom, and they still own that business, and they run quite a big part of their business in the United Kingdom. All right, so their majority business areas are disability insurance, where they pay for like different accidents, and when people become disabled, they have a lump sum payment, but also they provide the like monthly payments for people who get disability. Also, they have accident insurance, and here it's like, for example, if person was skiing and broke their leg, so they might pay it if there is a dental accident. So, for example, the boxer broke their jaw, they would pay for repairing their teeth or stuff like that. Okay, also critical illness insurance, but here critical illness, they deal mostly with a disease like cancer. Okay, and here they provide the medical like payment for medical treatment in this particular case. And also they have life insurance. So in case person died, they provide certain payments to their relatives, to the people who kind of get the cash after that. All right. I had life insurance. So if something happened to me, my children will get the money, but because I'm still alive, so the insurance company paid me all the money back after the policy expired. So this was kind of a different type of insurance, saving insurance. So, and our company, which we're analyzing today, dealing directly with private clients, also they deal with businesses for their employees, and also they deal with independent insurance agencies. There are different agencies which deal with different insurance companies for different markets. Okay, and so they sell some insurance policies through these guys as well. So they quite a big market as well in this particular case. Now that's what Unum Group is doing. So let's have a look at their value line report. Now, first of all, when the value line report was issued, it was 3rd of April. Just check it. I think it was 3rd of April. Yeah, 3rd of April, so it was 1.5 months ago, and the price at that time was $10. At the moment, it's $15. Now, at that time, price earning ratio was 1.8. Now we multiply by 50%, so it's close to 3%, like to 3, right? So based on PE ratio. Now, at that time, dividend yield was 11%. So now it would be roughly 7%. Something like that. Now, Value Line predicts, and they believe that within the next 3 to 5 years, the price of this specific company is going to be between $45 and $65, which represents about 330 to 500% growth within that period. Also, Value Line recently, like about a year ago, they added 18-month target price. So, and the 18-month target price is between 23 and 44. So average is 34. So it's still much higher than $15, which this company, this share costs right now. All right, so this is the price. Let's have a look at the performance, how this company is growing. So if we're going to look at the last 5 years, even not 5 years, even if we take longer, we can see the constant growth. So for instance, per share from 2014, $31, $33, $36, $38, $41, $46, $50. Now, we don't see here sales, we see premium, because the premium is the kind of the amount of premium they write for their clients. That's how they have. In banking industry, we will see here loans. In insurance businesses, we will see premium. So it's a bit different than from other companies where we see sales or revenue. Right. Also, we can see investment income per share. That's the income which they receive from putting money into different market, investing it somewhere. And they have different areas like bonds, probably stocks, also like mortgages, different other securities as well. Okay, so the net earnings, also if we look from net earnings, so we can see the growth as well. So 3.5, 3.6, 3.9, 4.2, 5. So we can see the constant growth. So it's quite good. So if we look at per share and then we go and look for the company as a whole, so we can see exactly the same. The company constantly growing. So there wasn't even 1 year within the last 5 years where the company went down. Now, because now it's different time, okay, it's more like a crisis time. So we have to always pay attention how company behaved during that time. Now, unfortunately, we cannot see here 2002, but we can see 2008. We cannot see in value line for the whole company, but we can see for specific share, right? So that's what we can see. From 2004, if we look at the premium, was 26.44, right? And 26.18, so it's a bit lower. Then it was 23.20, then 21. So we can see the drop in the premium issued. And but it was before the crisis. And then we can see the growth in 2008, right? And we can see a slight drop in 2009, just a slight, probably like $1 here. So it's what, about 5% annual, where a lot of businesses during that time, they lost a lot of their business. Their revenue probably went down in half. Okay, same as now, a lot of businesses still lost revenue in half. And look, after that, the premium started growing and never stopped growing until the current time. Okay. Now, also, if we look at the investment income in this particular case, also there was a slight drop from 720 to 707, and then start growing. Okay. And if we look at net income, like earnings per share, so we can see actually it was growing from 2005. Even the premium was declining, the earnings were growing up. So 1.6. 1.8, 2.1, 2.5, and again, so 2.57, and then it was growing. So when we look at a situation like that in this area, we understand that during that specific crisis, when a lot of businesses closed down, where a lot of people were unemployed, this specific business still performed pretty well. So if it was then, we probably can expect it now as well. Okay. Yes, there is a different reason for this particular crisis, but still the company is quite stable. So I believe that this particular company can be used as a protective asset in your portfolio, especially taking into consideration that it pays quite a lot of dividends. Now, about dividends, some companies, they reducing the dividends right now. Probably General Electric stopped paying dividends or reduced them quite a lot, and other companies, they're doing exactly the same. Now, let's have a look. Did this specific company ever reduce their dividends yield? So we can see that until 2008, we don't see the history previously, they were paying 30 cents. And during the crisis, they didn't reduce it. They actually increased it 2 cents in 2009. And then they increased again, and again. And every year, the dividend grows. So I presume if there is a history like that, lest likely that they're going to reduce the dividend. They might stop increasing it, but based on the income of $5.80, they still have some room for dividend growth in this particular case. Now, the second line is also very important. We can see that book value for this particular company is $49. So can you imagine that book value 49, whereas recent price, the price of the share now $15. So it means that if the company goes into liquidation right now, and we sell all the assets, if we can sell them, we're going to get $49. So the question, is it tangible or intangible? And we're going to look at this a bit later, okay? And then also when we look at common shares outstanding, we can see that the company constantly, not constantly, probably starting from 2010, they're buying back their shares, right? There was a 297 million shares, and now it's 202 million shares. So it's quite a lot. And they going to buy more shares from the market. So it means that they're reinvesting in themselves as well. This particular is okay, fine. Let's have a look at also at very important part is the debt. So we can see, we started talking about P ratio, right? So pricing ratio here was 1.8. Yes, correct, Dory. We're just going to go and look at the debt in a second. So let's have a look. P ratio. If we look from 2004, the highest probably was $11 or 11.4 times, right? And the lowest was 5.9 here and 6.7 in 2009. So very similar PE, right around 6 in the crisis time. So as we can see, insurance business never has high level PE. So if we compare it with like IT industry, we can see that the majority of them like 20, 25, 30, even higher, right? So here we can see like 5, 11, 10, so not higher than that. So, and the main reason, because people are afraid that if there is something happens and the insurance company has to pay a lot of like payments to their clients, it can drain their profit quite quickly. Okay, similar situation happened when the tornadoes affected the United States market. Okay, in this particular case. So, all right. So debt. Dory paid attention to the debt, and it's quite good. Let's have a look at the growth. So where is the debt? Income. Where is that? Dory, where did you see the debt? Return, share, total asset, insurance force, net profit. My goodness, why I cannot see it? Okay, I found it on Finvius. All right. Okay, in any way, so debt, we can see it here in capital structure. So we can see the total debt is $3.3 billion. When the price was $10, the total capitalization was $2.1 billion. With the current price of $15, the market cap now about $3 billion, and the debt is $3.3 billion. So it means that the debt is higher than total capitalization of the company. So if you decide to buy this company for $3 billion, you have to be prepared to pay another $3 billion for the debt which is there. Now it's quite high level of debt compared to the capitalization. So we have to ask ourselves the question: is it a sustainable debt, or is it the debt as Asana had, where they couldn't pay interest rate? So let's have a look at the net profit. So we can see that net profit here during last year, it was $1.1 billion. So the question, guys, so if their debt $3.3 billion and their net income after paying taxes and everything, $1.1 billion, how long it will take for them to pay their debt if they decide to pay just from the profit? 3 years, correct. So it's not that bad, okay? Because majority of businesses like that, they can extend that, especially if they have a good track record. Usually it has to have here the debt level, but for whatever reason, I can see total assets, share equity, return on share, return to common, all dividends. Okay, no debt here level. Strange. Now, in any way, another thing which is very important also, let's have a look how much cash they have. So if we look at the current situation, so we can see that bonds, they have $47 billion in bonds. They have different in policy loans, $3 billion. They have $2 billion in mortgages and other securities, $13 billion. So total, they have $67 billion in convertible investments. Okay, they can convert them pretty quickly. That's why they're in current assets. Okay, when we look at the liabilities, so we can see that reserves, 47 billion, policy claims, 1 billion, 1.7 billion, and others 7 billion. So in total, 57 billion. So we can see the surplus of $10 billion. So it means that they have their own capital here, about $10 billion. So the question, if they require to pay that $3 billion, are they able to do that or not? Okay, we definitely can see that they can do that. Okay, it's different from the company which we analyzed last year, where they, not last, a couple months ago, where they couldn't pay their debt, even if they sold the whole company. Okay, so here they have the cash on their account. So this is quite good thing from the kind of bottom line that we're secured in this particular case. Now let's have a look at annual rates, growth rates. So we can see the company is growing pretty stable, not quickly as some other companies, but quite stable. So if we look at 5 years, 10 years, it would be 5%. If we look at the last 5 years, it would be 7%. So earnings stable 7.5% within last 10 and 5 years. So stable growth. And they're planning to grow 4.5% in premiums and 9% in earnings. So they're going to increase their margin. And the bigger the company gets, the the easier for them to sustain this high margin for this particular. And we can see also the dividend growth around 11%, and they're expecting to have it like that in the future in book value growth as well. Okay, this is the company. So if you read about this specific business here, you will understand that the major reason for the price fall last year, because the price went from $58 to $24 in 2019, the main reason was because they stopped attracting new customers for long-term care policies. So there was kind of they're part of their business. They stopped expanding the selling. That they still have old clients, but they're not attracting new clients. But despite that, they still have a quite good projections for the future, because they already have that in place. They already know about it, and still they believe that earnings per share. Wait a second, by the way. Yeah, you have seen. So earnings per share are expected to be $7.6 within the next 3 to 5 years. So they believe it. And the earnings predictability for this company is quite low. So they're right 4 times out of 10. And stock's price stability is very low as well, 55%. So it means that company is very, like the price is very unstable. And if we look at the volatility, every year it can go 50% up and 50% down. Here it's nearly 100% up and down. Okay, so here it would be 300% probably up and down. So it's not for light-hearted investors, right? Because if you bought something for $30 and it went to $10, it's not that easy to stay calm and keep the shares in your portfolio. But this specific company can do that. Okay, but value line, they currently rank 3. That's what it says for year-ahead price performance. But at the recent quotation, long-term capital appreciation potential is attractive. However, conservative accounts should not note the equity low score for earnings predictability and price stability. Okay, so that's what I just said. Okay, this is the company itself, the value line, and also I'm just going to show you the STMIs, just how they're getting. You can see that the green, it's their actual earnings. Okay, we can see it's here it's a bit lower, here it's a bit higher, here it's a bit higher, here it's a bit lower. They just got what they promised. Here it's a bit lower again. And next quarter, it's quite huge range for kind of performance, because they don't know how the business is going to be affected because of this coronavirus changes in bond policies. Also, the United Kingdom is kind of leaving European Union, all these policies, etc., etc. So at the moment, it's probably going to be the biggest surprise next quarter, which we're going to expect. Okay, for this particular companies, this situation will affect the price as well for that particular company. So another thing, okay, and another thing which I wanted to show you is the balance sheet. I just want to show you one figure because that's kind of, you can read it later, but tangible book value per share is $47. So it means that it's actually tangible assets after you take all the assets minus liabilities and then divide by amount of shares, you get $47. So it means that if this company is going into liquidation today, we're going to get $47 per share, even though we're paying now $15 only. So for me, it's quite a good bottom line from the security perspective. To be honest, I don't know why the company, the share price is so low, PE is so low, where the like tangible book value is quite high, like 3 times higher than the current price. All right. Because when we look at value line, it's constant growth. Now, this number doesn't represent what happened during last quarter, because the company didn't report last quarter. So what I've done, I went to Interactive Broker and I looked at their last statement, including already first quarter, which is ended 31st of March. And as we can see here, compared with the first quarter in 2019, so the total premium was $2.4 billion, so which is higher than $2.3 billion, right? Slightly, but higher. But when we looked at total revenue, here it's 2.87 and here 2.98. So it was higher. Why? Because it had this kind of realized, unrealized gain loss. To be honest, guys, I tried to find it and look at different articles. Quickly, I couldn't find what was that. What was $144 million. But if it was one time off expense or loss, it might not be there next quarter. If it is not next quarter there, so it means that this number is going to be higher. So if they have growth in premium, so we're going to expect growth compared to the second quarter here, right? So that might happen. So of course, before you would put money in this specific company, I definitely would recommend you to go and look where this number came from. Okay, if you find it, and if it's not something very terrible and damaging, and it's not going to continue in the future, so most likely it's actually good for us, because it's affected the people perception about this company. They can see that, because the end result, when you look at diluted normalized earnings per share, here was $1.3 and now 79 cents. So it's about 40% drop in earnings. And majority of people, they don't bother look at this statement at all. What they do, they just look at the numbers. They can see that earnings dropped 40%. They say, oh my goodness, coronavirus affected it. That's it. We're going to sell this company off because next report is going to be even worse. But if we try to understand where this number came from, and if it is one time of payment for something, we might pick up this company for cheaper price. All right. So this information about this company, guys, I showed you good things about it, bad things about this company. So before I show my results, I wanted to ask you, what do you think yourself? Is it a good company? Is it undervalued company? Put your numbers, two numbers for quality, one and another one for price. So, or just write down, what do you think? Okay, Nona is saying 3/4. So who else? 3/4. Jeremy, need to see second quarter. Yes, definitely. What else? Anyone else? 3/4.